Monetary policy, the dashboard of the economy. John is sitting in his office at the top of the Neo Finance Tower, looking at a digital terminal. For the first time, his internal business metrics aren't the only thing he's watching. He is staring at a set of flashing numbers from the central bank. The news just announced a change in the target federal funds rate. Suddenly, the interest rate on the loan he was planning to take out for a new 3D printing facility has shifted. John realizes that his business does not exist in a vacuum. It is floating on a sea of liquidity, and the Federal Reserve is the one controlling the tides. This is the world of monetary policy, the strategic management of the money supply and interest rates to stabilize the economy. As Gregory Mankiw explains in his Principles of Economics, the Fed has a dual mandate to promote maximum employment and stable prices. To achieve this, the Fed uses a specific set of tools to influence how much money is circulating in the system. John needs to understand these tools because they dictate the cost of his capital and the purchasing power of his customers. The primary and most frequently used tool is open market operations. When the Fed wants to increase the money supply, it creates dollars out of thin air and uses them to buy government bonds from the public in the nation's bond markets. This is like the Fed injecting a high-octane fuel directly into the economic engine. After the purchase, these new dollars are in the hands of the public, which they then deposit in banks, kicking off the money multiplier effect we saw in the previous lesson. Conversely, if the Fed wants to decrease the money supply and cool down an overheating economy, it does the opposite. It sells government bonds from its portfolio to the public. When John or other investors buy these bonds, they pay with currency and bank deposits, effectively pulling money out of the system and locking it away in the Fed's vault. This reduces the amount of money banks have to lend, which pushes interest rates up. For John, this means borrowing becomes more expensive. He has to think twice before expanding his keyboard factory because the hurdle rate, the minimum return he needs to justify a project, has just gone up. The second tool at the Fed's disposal is the discount rate. As we learned, the Fed is the lender of last resort. When a bank is short on reserves, it can borrow directly from the Fed's discount window. The interest rate the Fed charges on these loans is the discount rate. If the Fed wants to encourage banks to lend more, it lowers the discount rate, making it cheaper for banks to bridge any temporary gaps in their reserves. If the Fed raises the discount rate, banks become more cautious and keep higher reserves, which slows down the creation of money. The third lever is the reserve requirement. These are the regulations that set the minimum amount of reserves a bank must hold against its deposits. If the Fed raises the reserve requirement, banks must hold on to more of every dollar deposited, which lowers the money multiplier. This is a heavy-handed tool and is used less frequently than open market operations, but it is a fundamental part of the Fed's control panel. When the reserve requirement goes up, the total volume of loans available to people like John shrinks, making the financial environment much tighter. But why does the quantity of money matter so much to John's daily operations? It all comes down to the theory of liquidity preference. In the short run, the interest rate adjusts to balance the supply and demand for money. The Fed controls the money supply, which is represented as a vertical money supply line on the economic graph, because the Fed sets it regardless of the interest rate. The demand for money, however, depends on the interest rate. If interest rates are high, John would rather keep his wealth in interest-bearing bonds than in cash. If interest rates are low, the opportunity cost of holding cash is small, so he keeps more money in his digital wallet for transactions. When the Fed increases the money supply, the supply curve shifts to the right. At the old interest rate, there is now an excess supply of money. People try to get rid of this extra cash by buying bonds or depositing it in interest-bearing accounts. This increased demand for bonds drives their prices up and, as a result, drives interest rates down. This is the magic of monetary policy. By simply changing the amount of money in the system, the Fed can move the interest rate. Lower interest rates stimulate investment because it's cheaper to borrow. For John, this is the green light. Lower rates mean his net present value calculations for new projects look much better. His keyboards become more affordable for customers who buy on credit, and his business expands. However, John must also be wary of the risks. If the Fed keeps the money supply too high for too long, it can lead to inflation. If everyone has too much money chasing too few custom keyboards, the price of those keyboards and the price of the plastic and electronics John needs will start to spiral upward. This is why the Fed is constantly fine-tuning the dials. They're trying to find the Goldilocks zone, not too hot to cause inflation and not too cold to cause a recession. John looks back at his terminal. He sees that the Fed has opted for a dovish stance, keeping rates low to encourage growth. He realizes that he is not just a passenger on this ship. He is a navigator who uses the Fed's data as his compass. By understanding monetary policy, John can anticipate whether the next quarter will be a season of cheap expansion or a season of defensive consolidation. He is no longer just building keyboards. He is building a resilient financial entity that can thrive in any monetary climate. He understands that in the world of neo-finance, the money supply is the tide, interest rates are the wind, and he is the captain who knows exactly how to set his sails.